So I'm here today with Stephen Yu, and he is celebrating 2 years of Blue Whale Capital, and you've just passed £200 million funds under management. Congratulations.
Thank you.
So the fund was launched with Peter Hargreaves originally. Tell us how you know Peter.
So Peter and I, we have known each other for over 17 years. And we knew each other when I first started my career at Hargreaves Lansdown back in early 2000. And since then, we have kept in touch and we have explored about the Blue Whale ideas a couple of years back. And we decided in 2017, it was a good time to kick off the project.
And why was 2017 such an auspicious time?
I think, to be honest, there would never be a perfect timing to launch the fund, and that was the time that I was available and Peter would be interested to go into a venture at the same time. But if you ask me in terms of the investment backdrop or the market backdrop in 2017, it wasn't an easy period. It was quite tricky time, and of course over the last 2 years as we have been running the fund, the market has become even more difficult. But to us, we are active managers. We do a lot of research in-house and we run a high conviction portfolio. So in a difficult market, it can actually showcase that we are adding a bit of value on top of what the market is doing. So I think that's never best time to launch a venture or a fund, but we just have to deal with what's out there in the market.
Well, your performance has shown that it was a good time to launch it, or maybe that's just down to your skill. What do you think that your fund offers that other funds aren't already offering?
Blue Whale Growth Fund sits in the IA Global sector. In our sector, there are about 300 funds. So we are one of the 300 funds. And it's a fair question to ask, so what are you doing differently to the rest of the industry? If I compare the performance of the average manager in the IA Global over the last 10 years, they have underperformed the equivalent benchmark or iShare MSCI World as a passive tracker by over 40% over 10 years. In order to be top quartile in the IA Global over the last 10 years, you would only need to mimic the benchmark return. Let's say if you use the iShare MSCI World Net GBP as some sort of benchmark or vehicle, that is a top quartile within my peer group. So what has gone wrong in the industry? I think one thing to us is that there has been lack of funds that run a high conviction portfolio. So typically in the global space, that is not unusual for a fund manager to invest into 100 stocks. Because at the end of the day, there are more than like 1,600 stocks in the MSCI World. So even having 100 stocks is not excessive. But once you have too many stocks, it's difficult to get the level of conviction. So what we set out to do is to run a high conviction portfolio of about 25 to 35 stocks. And if you look across the 300 funds, there are only a handful of funds that employ the same high conviction strategy. So there's another 290 funds that are not doing what we think that they should be doing.
And why do you think that is?
I think running a high conviction strategy does require a lot of resources. So at Blue Whale, we are committed to deliver significant performance. At the same time, from the business perspective, we have invested into headcount in expanding the team to continue to deliver on our performance. And typically, if you don't have that sort of target or ambition, then it's unlikely that you will be investing into a lot of resources. So hence, it would not be sensible if you have only a team of 2 people to try to run a high conviction portfolio, because the amount of time that you would get per company is not going to be enough. And on that note, you could potentially be taking undue risk in the stock that you're betting on. For us, there are a team of 4, and we are just about to increase our team to 5. And if you do the maths on having one individual working 10 hours a day, and there are only 2 of you covering 75 companies, on average, you spend about 5 hours per month per company in your fund. In contrast to Blue Whale, there were 4 of us and about to become 5. You do the same maths, 10 hours a day between the 4 of us, covering about 25 companies. We spend 6 to 8 times more per company per month compared to our competitors. So all this adds up. But typically, you don't get that level of resources in other funds if you're running a small sum of money.
So what are your investing caveats?
So the investment philosophy at Blue Whale is very simple, is to identify high quality businesses and invest into their shares at an attractive price. And in terms of company, we really like company that could demonstrate that they are competitive position, they have a lot of market share, they have pricing power, they have a good management team, and also they are not getting disrupted. So they are well positioned in the new world that they could continue to deliver the high level of return that they have generated over the last many years. At the same time, the shares that we invest into would need to be trading at an attractive price.
And are they easy to find?
The first part of the equation is the easier bit. So at Blue Whale, we cover about 100 companies. So out of the 1,000 to 2,000 companies that might be in the MSCI world, that we have identified around 100 that we deem as high quality businesses. So that is fine. But for us, within the fund that we invest into the best of the 25 or 30 at any one point in time. And how we go about that is to determine the right price. And I think that is a constant challenge.
And you do that through modeling?
Yep. So after we have spent a lot of time researching on a company, understanding the business model, understanding the historical financials on what are the key drivers to how much profit or what are the growth driver on a company, then we will translate our understanding into financial modeling. So we would construct a financial model for every single company that we have in the fund. And at the same time that we will try to make forecasts to project how much money the company is going to make over the next couple of years. It's very easy for anyone to make projections. We can all look out in 5 years' time what's going to happen in the world. Anyone could make a comment. And as we know, the world is very uncertain, so it's not easy to have any certainty what's going to happen. But for us, financial modeling is really to bring everything together that we understand about the business. So let's say if we look at a company that we feel that the underlying drivers are recurring, that they are not under any level of disruptions, they can continue to grow their market share in a certain industry, and then they continue to come up with new products, or maybe at the same time they have pricing power. So if you pull all this together, the final key is how you translate all your understanding into financial projections. And if we can do it better than our competitors or the market equivalent, then we could have an edge. But it's never perfect. So at any one point in time, we know based on the financial model that we have, the assumption that we have within our forecast, that's to the best of our knowledge to that point. But tomorrow or a few months' time, that could evolve and we would learn about new things, new information about the company, and we continue to evolve our understanding of the business and try to have an edge versus the markets.
So with the modelling, do you actually have quantitative factors that you can put against qualitative, so that if they've got a great competitive edge and a really good moat and they're a disruptor, does that give them more points? So that goes into your model, or is your model just about the revenue, profit margin, therefore what profit they're going to make and what earnings per share they're going to make? So is it a model that's just financial, or is the model pulling in qualitative data too?
Ultimately, any financial model, what it's going to tell you is what might be the key driver to the company's earnings. And to anyone who try to make a forecast, it's about the level of certainty or the level of conviction that you can get from any financial modeling. So what it means is basically the combine of the both points that you raise. So let's say if a company is not a market leader, is not gaining market share, it doesn't have pricing power, its business model is getting disrupted. If you have all these factors together at the same time for a company, and just imagine how you're going to forecast the future state of this company in 3 to 5 years' time, you probably cannot have the same level of certainty as compared to another company who is a market leader, who has pricing power, have a good management team, is a disruptor and their business model is not getting disrupted. And so in terms of the projection that you can make on that company, on a high quality company, that you can have more conviction in your numbers or forecasts.
And this enables you to get in at the right price and get out at the right price. But many people say you can't time the market, and that's a very difficult thing to do. Some people will put a short in on a stock and their story might be right, but they have to wait an awful long time for that story to play out. Why do you think you can get your timing so right?
We don't actually think that we can get the timing right. And going back to the investment philosophy at Bluewell is that we want to identify high quality businesses and we want to invest into those businesses at an attractive price. So what we are actually doing is that we want to continue to ensure that the price, the current share price that the company we invested into remain attractive. And to us, that's where the highest level of conviction comes in. So if at any one point in time the price started to become less attractive based on our assumption, our financial modeling, our understanding of the business, then we would have less conviction in that company versus equally another high quality businesses. At the same time, the valuation is more attractive. So we would prefer from Bluewell that to maybe reinvest some of the capital that we had in that initial company into the second company, which then would offer us a higher potential for outperformance.
And by doing that, you must presumably sell sometimes before it hits the top. And does that bother you?
If you look at the holdings that we have got in our top 10 in the fund, the top 10 holdings in the fund are the highest conviction part of the portfolio. So they account for up to 50% of the fund at any one point in time. And there has been a couple of holdings that were in the top 10 since we started 2 years ago and remain our top 10 holdings. But there were a couple of companies that they are no longer in the top 10. And some of them, they are still in the fund. Some of them, we have already sold them. And if you look at the share price of some of this holding that we have decided that we have less conviction in, some of them, the shares has gone up. But at the same time, some of the shares has underperformed. So we could be right or wrong on this decision. But what is important is the company that we have replaced with on the top 10 have done much better. So the new names that we've added since we launched the fund, let's say over the last year, the performance that we get from those companies are much, much better than the shares that we have sold or reduced, but continue to outperform. So everything is a relative game. So if we haven't done anything to the fund since we started, the performance would be less compared to the performance that we have delivered over the last 2 years.
Interesting. And in your top 10, how much movement has there been over the 2 years? How many that you originally bought into are still in it?
Just short of half, so about four companies.
And would you anticipate that that will be the pattern of things going forward? Do you anticipate that there always will be quite a lot of churn?
So the way that we think about this, or any investor in the fund can think about this, is the top 10 holding in the fund evolve over time. So at any one point in time, that would reflect the highest conviction from Bluewell. So the 10 names that you see today would reflect our outlook for this company over the next 12 to 18 months. And if you look back 2 years ago, the top 10 holding would reflect what we envisaged they would be the best companies that are well positioned for the first year or the second year of the fund. And recently we have just sold out of a company which has been a top 10 holding in the fund since we started Adidas. And we still like the company, but we no longer feel that its valuation is attractive. So we want to be able to redeploy the cash that we get from Adidas into other companies that we feel that is much more attractive in terms of upside. And for the couple of companies that are still in the top 10 that we still like, is because that the valuation remain attractive, even though that they have done extremely well. So this might brings me to my next point, is that the market is very efficient and the valuation gap at times can get close quicker than you think. So I would love that we have the top 10 hasn't changed. If the valuation of the holdings remain attractive today compared to 2 years ago. But it doesn't work like that. So we, in some capacity, that we are at the mercy of the market, that if they decided that our company we have picked the right company, and then they want to pay up for the shares, and the valuation become less attractive or become very expensive, then we don't want to continue to hold onto those shares. So I think the turnover is sometimes a bit misunderstood, that we are not trying to sell a holding or reduce a holding from the top 10 or change the top 10 because we wanted to, is that we are looking forward to the next 12 to 18 months to make sure that our companies or holdings are well positioned to benefit for the outperformance.
And all investors get it wrong sometimes. Are there any in your top 10 when you launched that aren't in the portfolio anymore just because they didn't do what you expected them to?
Yep, so we had a holding in the fund, which was a gaming company called Electronic Arts. And this company was quite interesting in a way that we really liked it when we first started the fund. So it was a top 10 holding for the first 4 to 5 months of the fund. And we liked the story about the digital download, the growing interest in eSports, and also at the same time that about its gaming content. So it does own the rights to the FIFA game, the NBA, the NFL, etc. And it's done extremely well in terms of the structural growth driver within the gaming space. But what we learned shortly after we have invested into the stock in early 2018, that there was this new game called Fortnite. And Fortnite was very popular and remained very popular, which is not a problem for us. The problem for us about Fortnite is that it has a new business model, which is free to download, and they only make money from in-game purchases. And this is completely different, or this is going to pose a challenge to Electronic Arts or the likes of Activision, that they still charge the user to download the game initially. So to us, that we do place a lot of emphasis in terms of company getting disrupted or potential disruption that might happen. So we decided to sell the holdings within quite quickly in early 2018, and since then the shares has fallen over 50% from the peak in 2018. So if you look back with perfect hindsight now, you will probably argue that it was the wrong company to invest into when we first started the fund in 2017.
Did you lose money on it?
We did not actually lose money. So if to go back to another question that you asked, that we made about 5 to 10% when we sold the holding. It wasn't a lot, But then since we sold the holding completely, the shares has gone up another 15%. But to us, that is not important because the risk of the company getting disrupted, which means a massive change of business model, a massive downside risk in terms of share price, is more important. So while we were sitting on the sideline, looking at the share price has gone up another 15%, but we weren't worried. We didn't know the timing of this impact might come to Electronic Arts. It could take a few years. And it actually happened quicker than we thought. So we weren't actually forecasting that it's going to happen within 6 months that we sold the holdings. We thought that, okay, maybe it won't happen at the end. But then we prefer to avoid company that can get disrupted.
And have you had any disasters? I mean, that was actually not a bad story. It didn't turn out so badly. But have you had any that just didn't do, and you lost money on them?
We did. I think I can give the example that Facebook would be one of the more controversial holdings in the fund for the last 2 years that we have invested into Facebook. The mistake that we made in Facebook was that we probably haven't factored in enough the regulatory hurdle or scrutiny they're going to face over the last 2 years or 18 months in particular. And the mistake that we made was that we underestimated the level of regulatory scrutiny, and hence the position sizing that we took on Facebook was probably not optimal when we first started the fund. So at one point in the fund, which I can't recall now, it's not at the beginning, but at one point in time in 2018, it was a top 10 position. So, but given what we know or what we knew after the first profit warning in July, that we have reduced our position a lot. So since then, you no longer see Facebook as our top 10 holding, but we still like the story. So it remained in the fund, but just we size it in a way that we factor in the macro uncertainty. But if you look at the underlying driver of Facebook, meaning the digital advertising potential, the Instagram, the WhatsApp, there's a lot of things going on within Facebook, which is doing quite well. But you probably have to put a discount to that, because at some point the regulator might go back to Facebook to say, maybe we need you to do this, maybe you haven't done enough, etc. So as an investor, I think that would need to be reflected. So that's something that we learned since the profit warning. Ultimately, we didn't actually lose any money in Facebook, because the price that we paid initially was quite a low price. But did Facebook actually outperform the market for the period that we invested into? It didn't. So it was actually a drag in relative performance terms. In absolute terms, it's fine. But for us, the most important thing is to deliver significant outperformance versus the peer group or the market. And if it hasn't done that, then it means that it's been dragged. So it hasn't actually helped the fund.
And what time periods are you looking for things to perform over? Because is it an annual period? Because stocks can move over a short period, and to say it's been a drag might be a misperception if you're only looking for 3 months. So what are you when you have your meetings, how often are you judging how things are doing?
I think share price is always it's not the best indicator to make an assessment on this. The way that we go about this is when we do financial forecasts in the model to determine how much money this company is going to make over the next couple of years. We normally take a view on over 3 years. And the way that we would then compare our forecast is with the consensus, which is also 3 years. So what it means is if you compare our forecast versus the consensus, that over a 3-year period, that if our forecast continue to be ahead of the market consensus, then it's likely that the shares is undervalued or the market underappreciate the potential of a company. But at any one point in time, without changing our forecast, if the market has then caught up with our expectation and become more optimistic than we are on that company, then we will feel that that company is expensive. So how quickly this timing would move is difficult for us to determine. So it could, that for example, we still like Adobe a lot in the fund. That has been a top 10 holding since we started. And it has done extremely well. So Adobe share price has doubled since we first invested in 2017. But our forecasts continue to be ahead of the market consensus after 2 years, and they continue to be a top 10 holding in the fund. But as I also gave the example on Adidas, that it has done well for us, but our forecast is no longer ahead versus consensus, which took 2 years. And some of other stocks took a shorter period. So the period that we would focus on is about 3 years, but the market could react differently.
And how long do you spend researching an initial holding that you are likely to buy into? And then how much time do you spend on them quarterly as updates come through?
So at Blue Whale, we follow a quarterly cycle. So typically for any stock that would potentially get into the fund, that we would spend at least 1 month on a company from the stage of idea generation to the stage that we would then build our financial model on the company, and then also at the same time that we will be doing some work on its competitor to understand, to get conviction on the industry dynamics. So that takes a minimum of 1 month.
So that's one person working on that one company for 4 weeks, 5 days a week?
It's actually a bit more than that. In terms of the output of that level work. So one thing that's quite unique at Blue Whale is that we have an open culture. So we have an open floor debates on any stock that are in the fund or not in the fund. So let's say if we have a new ideas, someone would have been covering the company for a couple of weeks, but then we would debate all the assumption about the company. We'll debate on the business model. We'll debate on the management team. We'll debate on anything about that company. So together is actually more than a month. Wow. In order for us to get to the level of conviction that we have to initiate a small position in that stock.
And when can you stop? Because if you've put a month into a stock, then you've almost got to buy it because it's spent so much time on your desk that you feel compelled. So how far into the process can you say this isn't going to work?
I think there's a couple of things. I think firstly that there's not a single answer to this. So as soon as we determine that the company is not a market leader or is getting disrupted or the business model is not sustainable, we will stop, no matter how far the journey is. I think one thing that is the industry faces, and which I think at Blue Whale we do it a bit better, is that we do place a lot of emphasis on the quality of a company. And no matter how much time we have spent on that company, that we have to move on if the company is no longer a high quality business. To do a new piece of work on a new company to get the level of conviction that we did have for, let's say, for holdings in the fund, is a very time consuming process. But I think that is the level of work that a fund manager should put into in order to ensure that the holdings in the fund would remain very competitive.
And then once you've bought into it, you quarterly look at the updates. How much time will you spend assessing what's going on a quarterly basis for one company?
Yeah, so every quarter we would at least debate on a company twice. So we follow a quarterly earnings cycle. And every time before a company report its results on a quarterly basis, we will revisit the business model, we'll revisit our assumptions, we'll revisit how far ahead we are versus the consensus. So before the company report its results, we would try to envisage what sort of result that we might expect from the company as a team. Once the result get released on the day, we will update our numbers, update our forecast, and then we will then debate as a team again what we think about all these results. Are the results, have the company delivered the results that we expected them to do? Or have we actually got some new information, whether it's positive or negative, that we might need to update our financial forecast? So that will be at a minimum that we would do it once a quarter. And of course, at the same time, between quarters, if there's new information coming in, then we will need to continue to debate on it. And one company that we have probably spent the most time debating as a team since we started is probably PayPal. So in between the four of us, I have estimated that we probably have spent over 100 hours talking about PayPal, plus the amount of work that we have done behind the scene. The reason for so much time being spent on PayPal is because that there's a lot of new information since we first invested 2 years ago. You have the introduction of Google Pay, Amazon Pay, Apple Pay, and we have to debate whether these new payment wallets are going to disrupt PayPal as a business. And because this is because new technology is an ever-evolving state, that you can never put a stop to say, okay, now I've debated enough on Apple Pay, which they have only recently launched a credit card, then we would have to assess whether this new credit card from Apple is going to potentially maybe change the consumer preference in terms of what wallet they might be using. So that amount of time that we spend on PayPal continues to add up, but I think it's important.
So your level of research is impressive and very time consuming. So when results come out and they're not what you expect, how quickly can you act? I mean, you have so much work to do that does it increase your reaction time so you're not nimble of foot?
So the results is probably the most important part of the cycle, because that would be the day that new information is getting released from the company, especially about the company itself. So it's not about the macro, but it's about the company fundamentals. And to us, that would probably the most important piece of information that we can get from a company. And so we would spend all our time and effort in order to get to the bottom of those results before the market opens. So typically, if you invest into US stocks, like we're sitting in the UK, which we do have about 2/3 of the fund in US companies, they report overnight about 9 p.m. in UK time. And the US market would open at 2:30 the following day. So for us, that before the midday next morning, we would have concluded what we think about the results. So as soon as the market opened, that we will know exactly what we need to do, whether we're going to invest more because we really like the new information that they publish, or maybe we would decide that our assumption has been incorrect. So maybe we want to reduce our holding based on the new piece of information. I think one point that I want to add on that this is only possible if you do all the research in-house, and then at the same time you build a financial model in-house to make the forecast. Typically, if you are dependent on sell-side analysts, which I think a lot of our competitors are still using brokers' research, it means that you would have to wait for the broker to publish their research. And then you have to then speak to them to say, what do you think about PayPal's results? What do you think about Adidas results? And then you need to speak to a few other brokers. And surely you might not be the first in the queue. So what happened if you didn't manage to get hold of the analysts that you were relying on initially for their ideas? Then you might have missed the opportunities, both on the upside or the downside when the market opens. And for us, the timeliness of coming to the right decision is extremely important. So hence, I think that ties it well together why we do continue to spend a lot of time doing research in-house.
And why US? I mean, you're based in the UK, you're on UK hours, you can't meet management in the UK because they're all US companies and they're in a different exchange. Why the US? Why 60% in the US?
So we would call ourselves bottom-up investors. So at the moment, if you look at our investable universe, about 100 companies, about 2/3 of the company in the universe are US companies. So, and that goes back to our philosophy that we like high-quality businesses. So as we sit here today, there are a lot of global businesses in the US, and they are extremely high quality. So it just happened that they are American companies, not British company. But in a different era, that we did have a lot of global companies in the UK that are very well positioned, but we have less of them today compared to then, and we just happen to find more US company. So in time that if the opportunities set change, evolve, we might have less in the US. So we are not tied to the US, and the view that we came to is all about the number of high quality businesses that we managed to find in the US.
And you don't think the US is toppy compared to other markets at the moment?
In terms of the company that we have invested into, the US company, most of them are very global. Typically, I think when people say, oh yes, the US economy is peaking, or the US economy is in a late cycle, but that is assuming that you're investing into US domestic company. So let's say the house builders in the US, or the construction company in the US, or the banks in the US, which we don't do any of those. So typically the businesses that we have as US company are the likes of Adobe, PayPal, Amazon. And do they have a lot to do with US? Sure, certain part of the business are still definitely like they are in the US because US is a big market. But if you think about Adobe, that is a piece of software that anyone else in the world could subscribe to if you want to use some sort of Photoshop, video editing software. If you're talking about Amazon, we're sitting here in the UK, that if you need to shop online, I think that's the go-to place. So I think if you if you go through the companies that we have in the US, that they are the global businesses. So we are less concerned about. So we have less focus about what the US economy is doing.
But
on that
market
basis.
valuation of the US stock market is higher valued than, say, the UK or Europe at the moment.
I think that's probably something that is quite misunderstood. The way we determine a company is undervalued is whether our forecast is ahead of the market consensus. So let's say if a company is trading at 25 times and our forecast is ahead of the consensus, typically the 25 times that people would be referring to would be based on consensus, right? If our forecast proved to be right and we're ahead, it means that the company should not be trading at 25 times, because then that would be earnings revision upgrade, and also at the same time that 25 times might actually be 23 or 20 times. At the same time, that if we were looking at a company trading at 15 times, which I think to a lot of people they would argue that 15 times is cheaper than 25. But if our forecasts are actually behind the consensus when a company is trading at 15 times, then it means if our forecast proves to be right, then it means that it's not trading at 15. It could be trading at 20, because then the market would have to downgrade the earnings, etc. So what is very confusing about the market now is that if you look at a lot of UK companies, okay, I probably don't want to name specific names, but we know about a lot of uncertainty in the UK economy, mostly due to Brexit, partly due to we are less competitive. A lot of companies are more domestically exposed. Even if we were talking about global companies within the UK context, you are talking about exporters. Who do they do business with? They do business with China. You're talking about commodities, oil and gas related. And they deserve to be trading at a lower multiple than companies that are not being impacted by some of these macro uncertainties.
So would you, in the future, if valuations changed across the world, would you look at other markets? Would you look at Europe? Would you look at the UK? Would you look at China? Where would you go? Where wouldn't you go?
So we run a global mandate. So at the moment that we do have a focus on developed markets, with 2/3 of the fund in the US, the rest in Europe and UK. In time, if we do see more opportunities in Europe or UK, that we would consider investing in UK or European companies. I think in the context of emerging markets, including China, to a certain capacity, that is unlikely the fund would have a big exposure to emerging markets, because firstly, this is a flagship fund for Blue Whale, so we do want to be able to scale up the product that we can manage a lot more money than today, which means liquidity is quite important. And if you start going into emerging markets, then the liquidity profile of the fund would change.
And it's unusual really to have such a deep research into such large cap companies. Is the idea of going into large caps because of the liquidity that you refer to? Or why large caps? Why not small caps, where some people feel that doing deep research there yields very big results?
Yeah, so I would make 2 points on that. The first point I would make is the level of outperformance that the fund has delivered since we started over the last 2 years have actually been very good, because if you put the numbers in context, that we have, and our outperformance has annualized over 10%. So the fund has returned to date over 22% annualized return compared to the market about 10. So we have outperformed on an annualized basis 10% more for each of the year that we managed the fund for the last 2 years. Not only that we are in the most efficient market in the world, which is US, at the same time that we are in the larger cap end of the market, so we're not in small cap. The reason being is like we want to make this fund a flagship fund, so liquidity is important, that we do not want to change our strategy if we do get more interest from investor. So looking back when we first started with £25 million, now we've just gone past 200. We haven't changed anything in terms of what we do. In time, we would probably be managing a lot more money today, let's say, I don't know, a couple of billion. We do not need to change our strategy, neither, because if you look at the average market cap of our holdings in the fund today, it's over £100 billion. So they are extremely liquid stocks. The second point I would make is, if we were going to go into smaller companies, so the less efficient spectrum of the market, then the level of outperformance that we can potentially deliver should be a lot more than what we've set out to do. So, and that might be something that we'll consider in the near future. But as far as this product is concerned, that we want to, this is our flagship product, so we want to showcase that significant outperformance could be delivered, even investing into large companies.
And in terms of stock turnover within the portfolio, what's your average number of transactions a year?
So we do have a target to say up to 75% in terms of turnover ratio for the fund, and that would include buy and sell. So, but typically, I think what you can expect is the top 10 position in the fund, as I outlined earlier, that it will evolve. So every couple of months that you will expect one name to come in to be a top 10.
So 6 might change in a year.
Yeah, correct. I think sometimes that the investor get confused about turnover versus performance, because surely if we have a higher level turnover compared to our peer group, then we would be paying more fees in terms of transaction costs. But at the end of the day, all the performance are net of fees, including transaction costs. So to us, it's more important that we, at any one point in time, that the company in the fund are the best company or the best shares. And if we don't feel that they are the best company to have in the fund now, then we would want to sacrifice the level of fees that we pay to replace it with something better. Because the worst thing that we can ever do is to say that, oh, we didn't have the best company. We had the holding in Electronic Arts. We have this suspicious that maybe the business model is going to get disrupted. But then we were sitting there to suggest that, but we probably don't want to sell the holding so quickly, because then other people would be concerned that you're going to pay some sort of transaction cost by selling EA to put into something else. But to us, having the wrong company in the fund is more important than anything else, because the level of fees that you pay, you are, at the end of the day, the level of transaction cost you are going to pay for any fund is probably maybe 10, 20 basis points for the entire year. So let's say 25 basis points to be excessive. The level of performance that you can lose by having the wrong company could be tens of percent. You could lose like 5% from having the wrong company.
So there's no setup charge to buy into Blue Whale, is there? How much is the annual management charge?
So we have two share classes. There's one share class that we charge 0.75%, and the OCF is 0.89%. And then we also have another share class at 1%, and the OCF is 1.14%. And depending on where you buy the fund from, so we have different arrangement with different platforms. And so in some platform that you might be able to get the cheaper share classes.
And what are your ambitions for the fund?
It's still very early days for Blue Whale, so we want to. For me, I think it's very important for us to continue to deliver what we set out to do, and in time that we want to use the Blue Whale Growth Fund as a flagship vehicle to showcase that significant outperformance could be achieved. And I would like to use this vehicle to demonstrate to the market that active managers could do well versus the passive, because I think at the moment the argument has been quite one-sided, because majority of the active managers are underperforming the passive funds. So hence that would be some argument to say that why don't we forget about active manager completely? Why don't we just put everything into a ETF or some sort of index tracker? But I think that would be the wrong thing to do. And for us, I think it's very important for us to justify that the active managers, even though the fees is a bit higher, that net of all fees, that you can still get significant outperformance versus the equivalent. And I think that is something that we would need to continue to do that over the coming years.
And your funds under management are now over 8 times the initial funds under management you started with. Where do you see funds under management being in the next 18 months?
I don't actually have an answer for that. I think it's still very early days for Blue Whale. So we are just about to celebrate our 2-year anniversary in September. And I think in the industry context, that 2-year track record is decent, but then we are still very short in terms of performance compared to someone else who might have a 3-year track record or 5-year track record. So for me, it's very difficult to set a target on an AUM. But what we can do internally is that we can continue to ensure that we deliver the level of outperformance that we have done in the past 2 years. If we can do that in the next 2 years, then I'm sure we would get more support from our investor that we would be managing a bit more money than today. So I think that is something that we can focus on, and the AUM is a difficult game.
Stephen, congratulations on all you've achieved, and thank you very much indeed for your time today.
Thank you very much.